Welcome back to The Explainer. So, when we talk about India's booming economy, it's super easy to just picture massive tech hubs, right? Startups, shiny urban skylines, all that stuff. But actually, the true economic engine, the real heartbeat of the whole operation, is out in the villages. Today, we're jumping straight into how structured credit is literally engineered to transform rural India from a landscape of traditional debt traps into one of dynamic, modern development.
Okay, let's dive right into this. Here is our roadmap for today. We're going to hit India's rural economy, the agricultural credit gap, cooperative credit structures, commercial and regional banks, and finally, wrap up with the microfinance alternative.
All right, Section 1, India's rural economy, and really the staggering scale of rural India. Get a load of this number. According to the 2011 census, a staggering 83.25 crore people live in rural India. That's almost 69% of the entire country's population. To put that into perspective for a second, we're talking about a demographic that's way larger than the entire population of Europe. And all of them are deeply dependent on this rural ecosystem. When you're trying to engineer financial systems for a group that massive, wow, the stakes literally could not be higher. Because for the country to genuinely grow and actually alleviate widespread poverty, economic development can't just be an urban thing. It absolutely has to be robust, inclusive, and sustainable right there, across these hundreds of millions of rural lives.
So how exactly do we tackle development on such an unprecedented scale? Well, the World Bank defines rural development as a strategy designed to improve the economic and social life of a highly specific group, the rural poor. So this isn't just about paving better roads or running power lines, though obviously those are super important. This is specifically about engineering systems that extend the actual, tangible benefits of development to the most vulnerable folks in society. We're talking about the small-scale farmers working maybe a fraction of an acre, the tenant farmers, and the completely landless laborers just seeking a livelihood. They are the absolute baseline for national growth. If the financial systems don't work for them, honestly, they just don't work at all.
Moving on to Section 2, the agricultural credit gap. Let's look at exactly why farmers need capital.
The core issue here is making that massive leap from traditional agriculture to modern mechanized farming. I mean, imagine the daily grind of farming using animal labor. It's incredibly slow, it's physically punishing, and it seriously limits how much you can grow. But transitioning, firing up a tractor, installing irrigation, or even just upgrading to high-yielding seeds and commercial fertilizers, that takes serious capital. And the stark reality on the ground is that the vast majority of Indian rural families simply don't have the personal savings to finance that kind of transition. They urgently need external credit. Sometimes it's just a short-term loan to buy enough seeds for the upcoming season. Other times, it's a long-term productive loan to buy that heavy equipment, which, by the way, is totally economically justified and absolutely crucial to permanently boosting their agricultural production.
But here's the catch. When those family savings run dry, where exactly does a small farmer turn? Historically, they've been pushed toward non-institutional sources, and this deeply entrenched system still makes up about 40% of rural credit. We're talking about informal village moneylenders. These guys often charge completely exorbitant, crippling interest rates. And to secure the loan, they demand the farmer's ancestral land or property as a mortgage. It's a dangerous, predatory debt trap that has literally ruined countless families over generations. So to fight this, the government stepped in with progressive institutional sources. The entire goal of these formal institutions is to provide adequate, timely credit at concessional, heavily subsidized rates, finally giving these small farmers a real fighting chance to afford modern technology without risking everything they own.
Which brings us to Section 3, cooperative credit structures, and how they engineered a tiered solution.
Okay, let's move to and see how this builds. To actively rescue farmers from those local moneylenders, a massive, highly structured system was engineered to reach into literally every single village. For short-term rural credit, loans under a year or two for immediate needs like fertilizer, the system relies on a very rigid three-tier structure. Down at the absolute grassroots level, right there in the communities, you've got the primary agricultural credit societies, or PACs. Then you step up one level to the district to oversee and fund those local societies, and you have the District Central Cooperative Banks, or DCCBs. Finally, capping the whole pyramid at the top tier are the State Cooperative Banks, the SCBs. It's a really fascinating piece of economic engineering. It basically ensures that huge pools of funding can flow safely and efficiently all the way from the state level directly down into the hands of the individual cultivator.
But wait, remember that tractor we talked about earlier? Buying heavy machinery or investing in permanent land improvements requires a long-term loan, usually stretching well beyond 5 years. To handle those larger, much more complex requirements,
farmers turn to a separate setup, the long-term credit cooperatives. And this system streamlines things by organizing at just two levels. First, you have the primary cooperative agriculture and rural development banks operating right at the village level as independent units. And second, supporting them are the state cooperative agriculture and rural development banks, which operate at the state level through branches in different villages. So it's basically a specialized, robust pipeline built exclusively for major agricultural investments.
All right, on to Section 4, commercial and regional banks, and the expansion of professional banking.
Now, cooperatives were an incredible innovation, right? Absolutely vital to rural survival, but honestly, they just weren't enough to cover the massive nationwide credit gap all on their own. So the solution to this was incredibly direct and highly physical. Commercial banks, these massive financial powerhouses you'd normally associate with towering city headquarters, were tasked with stepping in. They were literally mandated to provide rural credit by establishing brick-and-mortar branches directly within rural areas. Just imagine the sheer logistical shift that took. Uprooting standard, highly professional banking infrastructure from major metropolitan cities and planting it right in the middle of the countryside to serve rural businesses and individual farmers.
And this brilliantly illustrates the next big evolution in banking. A really clever hybrid established under the RRB Act of 1976, Regional Rural Banks, or RRBs. These specialized banks were created for one specific reason: to cater to the unique, localized needs of the rural poor. The genius of the RRB is all in its intentional design. They were structured as rural-oriented commercial banks, combining the low-cost, community-focused profile of local cooperatives with the strict professional discipline and modern outlook of commercial banks. Talk about a win-win, right? It was a tailored institutional innovation, bringing top-tier financial management to places that desperately needed it, but without all the heavy overhead costs of a traditional city bank.
Finally, Section 5, the microfinance alternative, reaching the most vulnerable.
So the crucial point here is that despite this vast, really impressive network of cooperatives and rural banks, a massive wall of friction still remained. Even when these specialized banks offered great concessional, subsidized interest rates, the smallest and poorest farmers were still frequently getting locked out of the system. Why? Well, because the reality of banking on the ground is pretty complex. The financial products were often incredibly borrower-unfriendly, demanding mountains of paperwork. The institutional procedures were plagued by extreme inflexibility and devastating delays. And worst of all, small farmers faced disproportionately high transaction costs. That means legitimate banking fees, sure, but also, unfortunately, illegal transaction costs, like bribes just to get a loan application reviewed. I mean, put yourself in the shoes of a farmer. If planting season starts tomorrow and you urgently need a small loan, you literally cannot afford a month of bureaucratic delays or extra illegal fees.
Because traditional banking maintained these sort of insurmountable barriers for the poorest citizens, non-government organizations, NGOs, started stepping in to provide a microfinance alternative, basically starting around the mid-70s. And this was a total game changer. By intentionally bypassing all the heavy bureaucracy and inflexible rules of traditional banking, these microfinance institutions, or MFIs, can deliver credit quickly and efficiently. They've been providing highly flexible alternative means to enhance access to credit, putting microloans directly into the hands of the marginalized people who need them the absolute most, precisely when they actually need them.
So we've seen how these incredible institutional structures, from those rigidly defined three-tier cooperatives, to the brilliant hybrid regional banks, to the super agile microfinance NGOs, have all been engineered to replace the dangerous cycle of non-institutional debt. But the ultimate test remains, doesn't it? As these modern systems continue to evolve and adapt, will they finally possess the speed, the true accessibility, and the deep grassroots reach to make the predatory village moneylender a ghost of the past? Honestly, the answer to that question will quite literally define the future for over 830 million people. Thanks so much for joining me on this explainer, and remember to keep questioning the systems that shape our world.